Hello everyone. In this video, I'm going to talk about the fat finger trade. It is a simple human error which could cause a market wide panic. Such errors is far more easy to commit than you can imagine if you are working in a large brokerage firm. Just a simple one wrong keystroke on a keyboard is enough. We are also going to see three examples of fat finger trade in Indian share market and two from other world markets. We will explore what these infamous trades are and the stories behind them. But let us first try to understand what fat finger trade is. A fat finger trade is a type of human error that occurs in financial trading, typically in electronic markets. It is a simple, unintentional mistake made while entering data into a computer that results in a massive and incorrect trade order being placed. The fat finger trade usually entails first, typographical error, that is, typo in the quantity or price of an order. Second, wrong stock or contract, that is, a trader might select the wrong stock trigger or a different derivatives contract. And third, accidental execution, that is, a trader might accidentally hit the enter key or click execute on an order that was meant to be a draft or for a different time. So, while a small time investor making a fat finger error might have a minor impact, a blunder by a trader at a large brokerage or institutional firm can have a dramatic effect on the market for a number of reasons. Like, first, financial loss. The firm responsible for the error often has to absorb a significant financial loss as exchanges typically do not annul these trades, holding the initiator accountable. Conversely, other traders who were on the correct side of the erroneous trade can make massive profits. Second is massive liquidity fluctuation. A huge erroneous order can flood the market with buy or sell orders, causing an immediate and sharp price change. And third is cascading effect. The sudden price change can trigger a chain reaction, activating stop loss orders from other traders and algorithms, while accelerating the price movement and can even lead to a flash crash or a sharp temporary spike. So, in essence, a fat finger trade is a non malicious but highly costly human error that demonstrates the risk inherent in the high speed electronic trading, where a single keystroke can move millions or even billions of rupees in an instant. It highlights the importance of robust internal controls, pre trade risk filters, and careful discipline for all market participants. So, now as we know what fat finger trade is, let's jump to the examples. So, the first three examples are from the Indian market. First of them is the MK Global Nifty crash. On October 5th of 2012, a dealer at MK Global Financial Services in India made an error while placing an order for an institutional client. Instead of placing an order for a value of 17 lakh rupees, they mistakenly entered the order as a quantity of 17 lakh shares. This single erroneous order worth over 650 crore rupees was transmitted to the National Stock Exchange as 59 separate market orders. This flooded the order book and caused the Nifty index to plummet by around 900 points. That is about 15.5% in a matter of seconds. The crash was so severe and rapid that it triggered the market wide circuit filter, which automatically halted all trading on the NSE for about 15 minutes to prevent further losses. While the market recovered some of the losses after trading resumed, the incident exposed flaws in the risk management system of both the brokerage firm and the exchange. MK Global Financial Services suffered a direct loss of over 50 crore rupees. MK Global admitted its error and worked with the BSE to close out the erroneous positions. The incident led to an investigation by SEBI, which censored the NSE for having inadequate risk management systems in place. Let's move on to the next example. This is the Nifty options blunder, again from India. This was a major trading mistake on the National Stock Exchange that is considered to be the biggest fat finger trade in India's history. On 2nd of June 2022, a trader at an unknown brokerage firm accidentally placed a massive sell order for 25,000 lots of Nifty call options with a strike price of 14,500. At the time, the Nifty index was trading around 16,600 and the actual market price for that contract was about 2,100 rupees. However, the RNS order was placed at an extremely low price of just 15 paise. 15 paise, not 15 rupees even. So 1 rupees equals to 100 paise. So 15 paise. The trader likely intended to sell a different option with a higher strike price or made a typographical error, which is why it is referred to as a fat finger trade. This blunder resulted in a massive loss for the brokerage house, estimated to be between 200 crores to 250 crore rupees. The RNS orders were executed, causing a sudden and dramatic drop in the price of the option contract. While the originating brokerage suffered a huge loss, other traders who were quick enough to buy the option contracts at the absurdly low price made a massive windfall gain. Reports suggest that at least two brokers in Kolkata made significant profits from that blunder. Let's move on to the third example. This one again is from India. It's for the clean science and technology block deal. The clean science and technology block deal was a recent event that is from August itself of 2025 in the Indian stock market, where a routine transaction involving the company's promoters went wrong due to a punching error by a broker. This incident caused significant volatility in the stock and exposed some weakness in the India's block deal system. Clean science and technology promoters planned to sell a portion of their stakes, approximately 24%, which comprises of 2.55 crore shares in the company through a block deal. But a block deal is a single trade of at least 500,000 shares or a value of 10 crore rupees. A broker, Avendus Spark Institutional Equities, which was handling the transaction, made a punching error. Instead of selling the intended number of shares, the sell orders were placed for a significantly higher quantity of around 6 crore shares. That is even more than twice the actual number. This massive unintended trade caused a huge spike in trading volume and led to a sharp drop in the company's stock price. The stock initially fell by as much as 9% before recovering some of its losses after the company and broker clarified the situation. The incident highlighted the limitation of India's current block deal system, particularly the strict 1% discount limit. Because the promoter's shares were offered at a 12.8% discount, the transaction was executed during regular market hours rather than in the dedicated block deal window. In response to this event, SEBI has proposed changes to the system, including increasing the discount limit to 3% and raising the minimum trade size. Okay, now let's move on to the fourth example, and this one is from Japan. In December 2005, in Japan, a trader at Mizuho Securities was tasked with selling a single share of a newly listed company called JCOM for a price of 610,000 yen, which is about 5,000 odd US dollars. However, in a costly fat finger error, they reversed the numbers, entering an order to sell 610,000 shares for just 1 yen each. The order was so staggering, it was staggering 41 times the total number of JCOM's outstanding shares. Despite this obvious error, the Tokyo Stock Exchange's system did not have a built in mechanism to cancel the trade and proceeded to execute it. The broker lost at least 40 billion yen, which is around 340 million US dollars. The incident prompted a lawsuit, and a court later ordered the Tokyo Stock Exchange to compensate Mizuho for a portion of the losses, acknowledging the exchange's technical failures. Let's move on to the final example, and this one is from UK from 2022. In May 2022, a London based trader at Citigroup made a simple but expensive mistake while attempting to manually hedge the bank's exposure to an index. The trader intended to sell a basket of equities valued at $58 million but accidentally entered that value into the quantity field instead of the notional value field. This created an erroneous basket of equities valued at a staggering $444 billion, 444 billion US dollars. Although Citigroup's risk control blocked a significant portion of the trade, about 1.4 billion US dollar worth of equities were still sold across various European exchanges. This triggered a brief but sharp flash crash that caused indexes in several countries, including Sweden, to plummet. The bank later admitted a loss of approximately 50 million US dollars from the incident and was fined 61.6 million pounds, which is equivalent to approximately 79 million US dollars, by UK regulators for its systematic control failures. So, as we have seen from all of these examples around the world, while a fat finger trade might sound like a minor slip up, a single careless keystroke can trigger a chain reaction, causing millions and billions in losses and shaking an entire market. It is a reminder that even in an age of complex algorithms, human vigilance remains the most critical component in ensuring the stability of our financial markets. Thanks for watching this video. If you have enjoyed the content, please like it, comment, share, and subscribe to the channel. Goodbye for now.